Hello and welcome, everyone. A warm good morning to all of you, and welcome to the third edition of the India Responsible Capital Conference, which is the sub-track of our IIM Ahmedabad's flagship conference, India Management Research Conference, IMRC. And thank you so much, all the researchers, scholars, students, faculty, and I also met a couple of practitioners in the room for submitting your research proposals, and also congratulations to all of you for getting accepted. This time, the third edition, we had over 300 research proposals sent for the conference. And after a rigorous, thorough review, we managed to accept 50 oral presentations. So congratulations once again to all of you who made it for the presentation round of IMRC third. Today, we have with us a very interesting panel, and we have two keynote speakers for the conference. And I would say, like the economists, the double coincidence of wants and needs, we have two exceptional leaders from their respective fields. First, Professor Gireesh Shrimali. He's the head of Transition Finance Research at the Oxford Sustainable Finance Group, University of Oxford. And we have Shri Manu Srivastava, IAS. He's the additional chief secretary, New and Renewable Energy Department, Government of Madhya Pradesh. So what do I mean by double coincidence of demand and supply? There are multiple coincidences we were just talking about. To start with, both of them are IIT Delhi alumnus. I guess nearby dorm rooms as well. Another coincidence is this conference is generously supported by Mr. Arun Duggal, 1974 batch PGP, also happens to be an IIT Delhi alumnus, super senior to both of them. So along with the PwC, the generous supporter for the conference. And what is a third degree of alignment and coincidence? Both of them are electrical engineers. Both of them have deep theoretical, conceptual, and practical experience in the energy sector. And both their paths have diverged somewhere in the middle. One walked towards academia and deep research, and another making exceptionally impactful contributions to the green transition movement in the country. So that is where we see this fantastic, jugalbandi between the two panelists that we have today. So the way we will structure the conversation is that Professor Shrimali would lay the groundwork from an academic, conceptual perspective, as we most of you are researchers, and it will help you to understand what is the broad contours of literature in this space. The conference itself, if you remember, started with a focus on how capital itself could become a catalyst for green transition. And over the course of the last 2-3 years, we have been building up this conversation from multiple vantage points. So in the first year, where we had Carolyn Flemmer, who is the editor of the sustainability track of management science, she built up a science, system science perspective on how finance comes and makes an impact. Last year, we had Professor Rohini Pandey from Yale, and she was building up from a market side, voluntary carbon market, how the market institutions could facilitate transition. And this year, we have with us Professor Shrimali and Shri Manu Srivastava, who will be talking from the risk perspective. How does climate risk and financial and physical risk manifest in the financial domain? How do you make measurements? How do you make assessments? What are the resilience and adaptation pathways that are available to businesses and policymakers? So that is the conceptual landscape, and then Shri Manu Srivastava would come in. He has achieved some world record-breaking achievements in the renewable energy projects, things which were considered impossible. For instance, getting a unit rate of electricity from renewable projects, solar renewable projects, with parity, what is parity to fossil fuel and coal, is something that was demonstrated by Mr. Manu in his REVA project. And you would be knowing, if you have taken the Delhi Metro, Delhi Metro's supply electricity comes from the project which was designed, the architect and designer is over here, and it was innovation of multiple instruments, but broadly it was about risk mitigation. How do you mitigate the risk of a project to make it financially viable? Okay, so we have these two sides of financial risk, how this risk mitigation enables transition. One, the theoretical landscape. The second, practical innovations. And I was talking to him yesterday. And I said, how you thought about it? What was the brainchild? Which research paper did you refer to? And he said, it was learning by doing. He's like action first, and then figuring out how this would make sense. So that way we will have very nice conversation from practice and theory. So once again, thank you all. This is the format of the talk that we have thought of. We'll start with Professor Gireesh, and he will take around 30 minutes talking about the broad landscape. And then immediately we will switch to Mr. Manu. I would request the audience to please jot down your questions so that after both the speakers are done with their respective talks, we will take the questions, and we will also engage in a conversation in a panel mode so that we can deliberate a little bit more in depth on whatever questions you have, and along with some questions which I have already prepared. I'm hoping I don't have to use them because you'll come up with better questions after the talk. So with that, let me first invite Professor Shrimali. Over to you.
All right, so let's get started. I wanted to highlight, and I first want to start by thanking Professor Anish for inviting me here and for the organizers. It's a pleasure to be here. It's been a while that I've been at IIM Ahmedabad. I had come to meet Professor Shukla about 10 years ago when I was at the Indian School of Business. So it's a pleasure to be back here. Before I get into my presentation and talk about what we do and what I'm going to focus on today, actually I want to highlight one other coincidence. While I have focused on academia and Manu has focused on practice, we have a very similar way of approaching things. We are both very interested in practical problems where the questions are coming from a decision maker, right? That's a very important kind of aspect, because if you're not working on questions that nobody's going to use the answers of, it somehow is wasted, right? So we want to look for questions that a decision maker is interested in. And the second part is, which is what we do in academia, is we want to do academically rigorous research, which is essentially saying we want to do and focus on methodologies and data sets that kind of result in results that we can trust. And I think we both do that, right? So we're just doing like the academically rigorous, practically relevant research, perhaps sitting in different places and different kind of angles. So with that, I'll get started. As Professor Anish has said, I'm going to talk mostly about this concept of physical climate risk. And I'll come to that in a second, but I also wanted to highlight where I'm coming from and where I am right now. So the research that we are doing and that we are kind of, I'm presenting today, it's part of this new program that we have set up called the India Transition Finance Program. So I just want to kind of take a couple of minutes to introduce the program. And this is based at University of Oxford. You see this picture behind you. which is a very kind of commonly used background in all Oxford presentations. This India Transition Finance Program is part of a group. It's a specialized group, and which is in a way, from an academic perspective, it's a success story. Because in academia, we talk a lot about interdisciplinary research. And typically when you go to universities that are focused on basically academic outputs, the interdisciplinary part gets very hard to justify. And so we are able to do that at Oxford. It's called the Oxford Sustainable Finance Group. And we focus on sustainable finance, various aspects of sustainable finance. We obviously do research on kind of the broad idea of sustainable finance. But within that, we look at nature finance, we look at climate finance, we look at asset level data, which is what we're talking about. So various things that are kind of at the intersection of sustainability of finance and policy. But beyond research, we also focus on education. We provide a lot of these free courses for the public and the third sector on kind of basic topics around sustainable finance. For example, if you're interested in learning about what is climate risk, there is a course on that. Or if you're interested in learning about what is transition planning, there's a course on that. These are like 3-module courses that are freely available to public and third sector. And then in addition, we also have executive education. Finally, it's all about people. So we also have what we call a lab, where we get our team together with other collaborators from outside academia, which is policymakers, decision makers, and as well as industry. For example, we have currently an associate from the Reserve Bank visiting us, working on something that I'm going to talk about in a bit. So this is kind of what we do. It's called the Oxford Sustainable Finance Group. And within that, I have this program called the India Transition Finance Program. A little bit about my current portfolio. So while I've spent time at various institutions, I had a stint as an electrical engineer, and after that I did my PhD, and I landed up at the Indian School of Business as the beginning of my academic career. I spent time at Stanford, and now I'm at Oxford, and what I'm looking at it is basically 3 broad areas. I look at what we call environmental stress testing and scenarios, which is related to climate risk, which is what I'm going to talk about. And that's a lot about how do you measure climate risk. The second area is what you see in the middle, which has to do with how do you do transition planning around risk management. Because just measuring is not enough, you have to manage the risk. So that's a lot to do with what we call transition planning, and that's also kind of started to focus on what we call net zero transition planning. The third area that I focus on is called the energy transition risk and the cost of capital, which recognizes that cost of capital is a key driver of any transition, especially given the differences in the capital expenditure between fossil fuel-based power or fossil fuel-based technologies and renewable technologies. So we look at how is cost of capital changing, what are the differentials, and what are the drivers of cost of capital, and as well as how cost of capital impacts decision making. And so all these 3 kind of broad areas kind of have come together in the India Transition Finance Program. One last slide on the India Transition Finance Program. Even though I talked about these 3 broad areas, the mission is much broader, right? What we want to do within this program, and we're also talking about collaboration with IIM Ahmedabad, is we want to accelerate market shift, right? What we eventually want to do is we want to move capital towards sustainable technologies, sustainable outcomes, right? And while we do that, we have to also make sure that we are kind of maintaining or enabling a just transition, because you'll hear this term again and again. While doing that, we also make sure the system, whether it's the economic system or the financial system, remains resilient to the change. So those are the 3 things we work on, and the strategic pillars are similar to what we do at the Sustainable Finance Group. All right, so let me quickly move into what is the focus of today's talk, and we are going a little bit deeper now. I've already talked about what the group does, what my focus areas are, and within my focus areas, one of the things I look at is physical climate risk. So what this talk is going to focus on is how do you measure mostly how do you measure, but also how do you manage physical climate risk. And there are a lot of terms here in a bottom-up fashion. It will become clear. But the whole idea is that we start at the asset level. We are looking at power plants, right, at the power plant level. So that's the whole idea. We're looking at the bottom-up fashion, and then from the power plant level, we can aggregate up to firm-level impacts, we can aggregate it to financial institution impacts, and then to economy-wide impacts. One other thing I'll say is we're focusing on flood risk in this, and I'll talk a little bit about physical risk in a bit, but basically we're looking at flood risk on the power sector generating assets in this talk. And this work is jointly done by a couple of my colleagues, Dr. Abhinav Jindal, who is the Power Management Institute in Delhi, and Dr. Ruben Kerkhoffs, who is at KU Leuven in Belgium. And these are a couple of papers that we've been kind of working on. The one on the right-hand side is more on the methodology. I'll talk a little bit about the methodology. And the one on the left-hand side is more of an application. So now coming to physical climate risk, and for folks who are not clear on what is physical climate risk, it's essentially as climate changes around us, right, and climate is changing around us, we are seeing the extreme impacts of the changing climate, right? And any of the risk that's generated because of the changing climate is what we call physical climate risk, right? So it could be increasing heat waves, it could be increasing floods, it could be increasing severity of cyclones. All of that falls under what we call physical climate risk, right? And the idea is that when there is physical climate risk, right, I mean, climate and weather are around us all the time, but what we are starting to see is because of climate change, they're getting worse over time. That results in economic impacts, and that results in kind of financial impacts, and that's what we want to get to. So these are some examples that are kind of India-specific, right? And these are also, you will see, there are more economy-wide examples of what happens in an economy. There's an example of the cyclone Amphan, right? But these are just some of the examples that show us that the climate physical risk is kind of there for us to manage, for us to measure, and we need to kind of start doing it in a somewhat of a robust manner. And that was kind of the setup of this kind of research that we have been engaging in the last couple of years. So just a little bit more on climate risk and why does it matter. And obviously it can matter in many different ways. But what we are interested in is the financial impact. So what you see on the right-hand side in this diagram, right? The idea is that, and also we are focused mostly on businesses. You could also talk about financial risk at the household level, right? But we are looking at individual entities, right? Or individual banks or individual asset owners, et cetera, right? What kind of risk they're going to face because of climate. And typically, what we are saying is that climate risk, if you look at from a financial risk perspective, again, looking at the right-hand side, it's not that climate risk is a kind of a new type of risk. I mean, the risks that I've listed here on the right-hand side, credit risk, market risk, underwriting risk, et cetera, they're all risks that the financial sector deals with, right? But what's climate risk doing is kind of feeding into these risks through various channels, okay? And in the middle, this is the channels that we have talked about. The channels could be, there's a property damage, right? There is a flood, there's a property damage on a power plant. Now what you have to deal with it is not only you have to kind of wait for the property damage to be fixed, which means you have to spend money on it, which is capital expenditure, that has an impact on your cash flows, but also now you have disruption in your production, which has impact on your revenue and therefore, again, on your cash flows, right? So that's an example. But similarly, we can look at other impacts. And then on the left-hand side, what you see is what are the actual climate risks that are feeding through these channels into the classical financial metrics that the financial sector cares about, right? And at the bottom of the left-hand side is what we have the physical risk that I've already talked about, right? And by the way, when we talk about physical risk, we are talking about these severe events that I was mentioning, because the severe events are easier to remember, right? I have a flood, or there's a heat wave, et cetera. They're easier to remember, and they are increasing in severity and intensity and frequency, right? So we had to deal with that, and they're called acute risks. But there's also this issue of chronic risk. Over time, because of increasing heat or increasing temperatures, we could have an impact on productivity. And that kind of feeds into like economic impacts as well as financial impacts. So that's physical risk. In my opinion, it's actually easier to understand for a kind of a regular lay person because we see stuff happening all around us, right? But there's another kind of climate risk which is called the transition risk. And that arises, by the way, the transition risk arises because of our own actions of our community, of our society, of our policymakers. The actions that recognize the physical climate risk and that they try to manage it or they try to reduce it, and therefore we kind of engage in a transition, right? Why do you think we are doing a lot of solar, right? Because we're trying to manage it. But when we're managing this transition, that also creates a risk. For example, if the Ministry of Power is deciding that they want to do more solar, it is creating kind of a risk, a financial risk for power companies that are using coal power or gas power because their power is going to be used less, right? So these risks are kind of coupled. They're not independent of each other. That's what I want to highlight. And while we have worked on both of them, I'm going to focus mostly on the physical climate risk today. I'm not going to talk much about this. What I wanted to highlight was you can do this risk analysis, which is, again, what the diagram I had on the slide or two ago, which is you have a risk, you have something happening in the natural world or in the markets, and that kind of flows through kind of economic and financial channels to financial metrics that a firm or a financial actor cares about. You can do it many different ways. These are two kind of categories. We focus mostly on the right-hand side, which is called the bottom-up modeling approach. And this is connecting to what I had said in the beginning. We focus on the asset level analysis, which is what I'm saying is that in this example, it's going to be power plants. We look at climate physical risk at the power plant level. Okay? And then what you can do is you can aggregate it up. I can say, okay, maybe NTPC has a certain number of assets. If I have access to the risk, and I still haven't defined what I mean by risk, I'll come to that in a second from a financial perspective. But if I have an understanding of risk at the asset level, I can add up. I can add up those 10 assets that I have at NTPC, add up the risk of those assets, that becomes NTPC's risk. And now if I go to a financial portfolio or a bank that holds kind of credit to NTPC, then it becomes the bank's risk, et cetera. So you kind of go from bottom up, and that's the approach we have used. All right, so now actually getting more into the results and what we actually did in these two papers. Very quickly, how is the physical risk, and this is what I said, right? We try to measure and manage physical climate risk for power generating assets. We are looking at floods, okay? But any kind of physical risk, whether it's cyclones or floods or heat waves or extreme events, there are basically three components of that from a kind of how do you calculate risk. The first component is hazard. You have to get a sense from a science perspective, what is the hazard, how severe the hazard is, how frequent that hazard is, right? So that's called the hazard, or H. The second thing we need to worry about is, even if there's a hazard, let's say there's some floods in Ahmedabad, right? Is the asset that I'm wondering about, a power generating plant around Ahmedabad, is it asset exposed to that hazard? So that's the exposure part. And the third component is, even if the asset is exposed to that event, like say flood, is the asset vulnerable to the flood, right? So those three things come together to create what we call a perception of what is actual risk. And here also, again, we are kind of staying in an abstract manner, right? I haven't gone to the financial metrics. I'll come to that in a second. And for an example, we could have two assets facing the same hazard, having the same exposure, but one asset is better protected against floods. Let's say it's on a platform. Just a simple example, right? So that second asset, which is on a platform, is less vulnerable, right? And that's where adaptation, resilience, and managing physical risk also comes in. All right, so very quickly to the methodology. It's basically a multiple step process. And what we did was we have a stochastic flood simulator, right? So what we are doing is we are simulating floods in the next, I would say, 50 years, right? So that's very key, right? Because you're not trying to actually look at what happened in the past. That's the key distinction. What happened in the past, even in financial markets, is not a good predictor of the future. But in the climate space, even less so, because the climate is changing. The climate that we see in the future is not going to be the same as the climate we have seen in the past, right? So obviously, we have to kind of create these models and forecasting models that kind of learn from the past. We have to do some back testing. But now we have to create these forward-looking models that kind of predict how these events are going to happen over the coming decades. So that's the first thing. You have to create this flood events, right? So that's the first thing we do. We basically create these flood events in different river basins around India. And this is all focused on India. And for example, I've given 2 event sets, but the first event set says at time t+1, there's a flood of 5 meters at a power plant, Lara, right? But in the second event set at t+1, there could be a flood of 9 meters. So these are all probabilistic kind of scenarios that are being playing out, and each scenario has a probability. So basically, we create these scenarios using Monte Carlo simulations. So that's number 1, hazard, right? The second thing that we want to do is we want to focus on asset level data, as I have said before. So we have to see where each plant is. So we basically went around and mapped all the plants, right, in India, more than 400 power plants in India, right? And then we looked at each plant as to how this flood events, based on the location of the plant, is going to affect the plant. So that's why the asset level specificity is important. It's not where the headquarters are located, it's where the assets are located. That becomes very important. And then we have to look at asset by asset. We have to think about not only where the asset is located and what kind of asset it is, but what kind of protection measures is the plant using, what kind of insurance the plant has, et cetera, et cetera. So this is the plant level variation that we need to worry about. But that's the plant level stuff. The third thing is, now we have, as I said, we have an event happening. We have flood events happening at different depths. What we need to figure out for a particular plant, in this case, again, is Lara, but it could be plant A or plant X. What we need to see is what are the channels through which this flood event impacting the financial metrics of the power plant. And in this case, we are focused mainly on cash flows, right? But the channels that we've used are 3, and I'm not saying these are the only channels. These are the 3 channels we have considered. The first is direct capital damages, which is what I talked about before, right? There's a flood, the power plant gets damaged, right? Something happened to the turbine, something happened to the condenser, et cetera. So there's direct capital damage, which you have to now fix or replace. So that's what we call capital expenditure impact, direct capital damage. The second is what I had said before again. If a plant is hit by a flood and the plant is exposed and vulnerable, then there are going to be production disruptions. You might lose production because now you have a damaged condenser. You have to replace it, you're out for 30 days, which means if you have a power purchase agreement, you're losing your revenue around those 30 days. So that's production disruptions, right? And that has an impact on revenues and cash flows. And finally, we also kind of considered insurance. I won't get into details of that, but insurance has its own complexities. But at the end of the day, what's happening? All of these 3 things are impacting the cash flow of the power generating assets, which Manu is very familiar with, but at the end of the day, there's a PPA, power purchase agreement, which kind of assumes that the power plant has a certain return based on the cash flows, and cash flows are getting impacted looking forward. So obviously, the return that the investors and the plant owners are expecting are not going to be what they expected them to be, and that is the risk they need to be aware of, because the financial sector and the investors have to make decisions based on these things that has traditionally not been done. The final step in this process is you have these 10,000 events. I've just talked about 2 events here. You have 10,000 events. Each of the events is running for the next 20, 25 years. Each of the sets is running for the next 25 years, which is, let's say, the lifetime of a plant. And it is having impacts on the cash flows. So now if I have these kind of impacts of the deltas on the cash flows, I can use discounted cash flow methods to figure out what is the impact on the value of that power plant, right? That's essentially what we do. And what we show here is based on those 10,000 simulations, a histogram of what is the likely impact on NPV or net present value, right, based on the cash flow impacts, right? So what you're trying to see is it's not one number, it's a histogram that you see, because we actually ran, if you recall in the beginning, a stochastic simulator or a probability-driven simulator, right? And what the histogram is showing is on the x-axis is the net present value. To the right bottom is 1, which is no impact. And then as you go to the left, you start seeing impacts, right? And then you can figure out these, what we call quantiles. An equity investor might focus on what we call the median impact, whereas a debt investor might focus on a P90 impact, et cetera. Or insurance companies might focus on the P99, which is the 1% most on the left-hand side. So there's a lot of these things that come out of these simulations. I am looking at time, so I'm going to skip this, but there's a bunch of stuff here which kind of talks through what methodologies we use. But these are all in our papers. Happy to kind of talk about them during the panel discussion or afterwards. But the whole idea is, as I said, we have an event simulator that creates events, and those events are propagated into cash flow impacts, and then we look at the histograms of those cash flow impacts. So let's talk a little bit about, in the last 5 minutes, on what impacts do we really see, right? Because all this work is great, but is there an impact that we need to worry about, right? And a little bit of history here. If you look at what's happening on the climate risk measurement side of things, which is what the central banks are asking for, which is what the regulators are asking for, like SEBI, et cetera, that we need to be able to measure risk, physical risk and transition risk. Most of those efforts are focused on what we call the chronic risks, which is long-term impacts, right? And most of them have resulted in very low impacts, which has led people to believe that this is not a problem. But the problem was not that the numbers were low. The problem is we are not measuring the acute risks, which is a bigger problem. And we'll show here, actually, we see significant impacts. So this is, again, the paper. And this is we start to get into some of the results. So what this table is showing is, by the way, very high level. As I said, impact on net present value. So, and then impact on net present value, in a very simple way, you could think of that as, what's the impact? And again, I'm making assumptions, but that's the impact on the stock price, okay? Right? Because when I have net present value impacts, this is what the stock analyst is looking at, right? So what we are trying to see is, if I have a base scenario, which is the top kind of row here, and I have very low flood protection, my average risk, which is my average impact, right, on my portfolio is about 20%, right? I'm losing 20% value if I kind of account for physical risk and just the flood risk. And if I worry about the extremes, which is the insurance companies, the risk is up to 25%, right? These are significant numbers. I mean, you have to just stop and reflect. 1/4 of the value is being lost, right, because of just flood for the portfolio that I'm looking at, which is power generating assets. So that's the one key takeaway, that these risks are significant, right? And this is just one risk. We haven't looked at cyclones, we haven't looked at heat, et cetera, et cetera. And when these risks will occur, and they occur, they will have a compounding effect. And that's something that we are looking at. One other thing we haven't looked at is, this is just asset level stuff. If you start looking at supply chains, the risk goes up further, right? We have looked at supply chain impacts where we had coal mines and coal power plants in a supply chain, and the risk goes up like nearly twice of what you're seeing here. So these are significant numbers, and obviously we are happy to kind of discuss these and kind of defend these numbers, but the idea is that this is a good starting point for us to kind of start thinking about physical climate risk in a serious manner. A couple of other things I'll highlight here. If you look at the first three rows, what they're talking about is the base scenario means there's no protection, right? A power plant was not protected against floods. But then we could use different protection levels, and this is where adaptation and resilience comes into play, right? The moment you have resilience, the numbers drop, right? If I have medium protection, the numbers drop like, 1/5, right? If I have kind of high protection, the number drops another 1/5. So it's not that the risk is high in all cases. If we plan well, and that goes into actually initial planning of a project, we could reduce risk. So that is the key takeaway that I want to kind of depart here on. I'll try to wrap up. I've kind of used up close to my half an hour. There's a few more slides, but I'll just try to focus on a couple of other key things that we looked at. One other thing that we looked at was, it's a kind of a busy slide, but what we want to do was, okay, the first result that you see was a portfolio of all power assets, right? Everything combined. So I said we have power plants, which are gas, coal, nuclear, bioenergy, et cetera, et cetera. By the way, we didn't look at renewable assets. That's something that's ongoing. And the result was everything together. Then we said, let's look at different kinds of assets. And this is where you have to get into specific, right? And let's say we want to look at different kinds of assets. So this is what that's showing. It's different kind of power plants. And what I want to highlight very quickly was, I'm just focusing on coal power assets and the gas power assets. And you'll see that the coal power assets are better, have lower risk than gas power assets. And we can get into why. But you can start getting this granular information based on just technology types. Similarly, you can start looking at state level impacts, right? Which states have higher risk versus which states have lower risk, right? For example, we see Kerala, the power plants have much higher risk than compared to somewhere in Rajasthan, right? Just for the flood risk. And some of that you can explain away. But what the whole idea of this exercise was that if you could do asset level analysis, you can combine those asset level results in any which way you want, depending on who the stakeholder is, because maybe there is a Kerala policymaker that's interested in what's happening to the power assets in Kerala, right? And we kind of start looking at that. So there's a lot of stuff you can do if you have this very granular information at the bottom. You can also start looking at state level protection measures and what's the impact of those protection measures. But anyway, where I wanted to end up was, and the key messages, if you could just remember those, right? That physical climate risks should be evaluated because the likely impact is significant. And that's the key message, right? I mean, you were seeing up to a quarter of the value just from flood risk. Not only that risk should be measured, risk should also be managed, right? Because if you're making a financial decision, whether you're an investor, whether you're a bank, you will need to know what is the risk, but how is the risk managed so that you can make your own financial decisions. So that's number 2. Number 3 is, and I think we'll get into that, some of that in our discussion, is also what is the role of a policymaker and regulator in this, right? The questions that come up are, should the regulator, which is SEBI and SEBI as well as RBI, how should they mandate kind of measurement of risk? And I know, by the way, RBI is already thinking about regulation and measurement of risk. They have a circular out. But how should they do it? What should be measured? How should be measured, et cetera, et cetera? Because so that this information is transparent, because transparency is important. So that's where kind of I'll end. The final thing is, which is what we didn't get to in today's talk, is from a central policymaker's perspective, another question is, if I could protect only 10% of the assets, which assets should I protect? If I could protect only 25% of the assets, which assets would I protect? Because there's a cost associated with protecting assets. So those are kind of questions we're trying to look at as well. But it's been great to be here, and hopefully you got a sense of what we do, also what kind of research we do. This is one of the samples. Happy to share our website, various research projects, etc., if you're interested. But would love to stay connected, and let's stay in touch. Thank you so much.
Thank you so much, Professor Gireesh. Before we move from theory to practice, I would like to, for the benefit of the audience, sorry, it's all right. So for the benefit of the audience, I would like to sort of make a couple of more points, slightly off the script, but it started, this coincidence of people coming together, makes me think. Professor Amit Garg is here. His students are sitting behind him. Our students are sitting behind. And when we started off this conference 3 years ago, many of them were sitting in the audience like researchers, early career researchers, and exploring ideas. And we keep talking to our students and telling them the cliched Steve Jobs argument or the statement that you keep making dots and these dots connect in retrospective. So what I see is some of the dots are like connecting in retrospective. We build up these connections way back in the past. In fact, the very reason why we got connected is at IIM Ahmedabad we have a history of, thanks to Professor Shukla and Professor Garg, a history of exceptionally good climate, I think India-specific, one of the best India-specific climate prediction models, like various integrated assessment models. And at the center, we started working on asset distribution. What kind of, what is complementary? What is it that we can complementary and add value to what the work Professor Garg's team is doing? And as we started developing, we had a paper on floods. We mapped out assets. We looked at floods in India and started seeing what is the damage, retrospectively. And in the course of doing research, we found out Professor Shrimali's team is doing a very similar work, but prospectively, what is happening in future. And Professor Garg's team is working on how to predict those futures, right? And like a startup, as a researcher, you have to start thinking like a startup. So there is something called research entrepreneurship. So I hope that you use this platform as an opportunity to build up those connections, and we will be happy to facilitate. Now we have over, I guess, 700 plus, 900 plus researchers around the country who have, over the last 3 years participated in this conference. And at IMA, we feel that we should make this as a platform where all aspiring researchers from around the country who want to work on sustainability could use our resources. We could create opportunities where researchers can sort of build that up. And talking of entrepreneurship, using that as a segue, I would invite Shri Manu Srivastava, because we do plan, do, check, act. He does the other way around. DPCA, do, plan, check, act. So action first, build theory later. So let's hear from Shri Manu Srivastava. Over to you, sir.
So before I come to the presentation, I think I should have some sort of a background about what I'll be talking on. So this is what Anish suggested. Very often I would have started the presentation, but he said that we must give a background first. So firstly, I've been working in renewable energy, and as you mentioned, I'm an electrical engineer by education. I've been working in this sector. So broadly speaking, the word view is that renewable energy is something that is very expensive. And I think it emanates from our understanding of the world around us, of philosophy, of religion, and things like that. I've always wondered, I don't understand religion at all, but from what little I know of religion, I believe that if there is a God, the God would be everywhere. But all temples are on top of hills. Because the idea is that anything that is pious, that is good, should be difficult to achieve, should be inaccessible, should be a difficult process. Chocolate is tasty, is supposed to be unhealthy. Garlic is supposed to be healthy, supposed to be bitter. But in renewable energy, we are now at a happy stage, at a happy moment, where renewable energy is both economically viable and environmentally beneficial. So that is the important point, and I think what I have done or what we have been doing and what excites me is really work in that direction. So that I think is the background that Anish said that I must.
How to make garlic sweet as
Yeah,
chocolate?
yeah. I mean, if chocolate, if it is a garlic chocolate.
Garlic chocolate, all
Yes.
right.
So renewable energy today is garlic chocolate,
Yeah.
which is beneficial and it's tasty. And the work I have done has been to make that happen. So that broadly is the work, and also he asked me to give some sort of a background because he said that some students here would never have paid electricity bills, so they wouldn't have any idea of electricity at all. So just to give you an idea, I mean, the electricity that we all pay in our residences or our offices is around roughly, you can say, 8 rupees per unit. That's the broad idea. And so once you have that in your mind, what you're paying, then everything else would make sense, because I would talk a lot of rupees per unit. Because when I say renewable energy has become cheaper, so you have to compare with what the rates are. So just keep in mind that you pay around 8 rupees per unit for electricity at your residence. Okay, now how our project came out to be, and broadly speaking, something that I and Gireesh were also discussing, that all climate projects are increasingly becoming more viable with better technology, etc. And a lot of things are happening because of which it's happening. It is technology, it is economies of scale, efficient supply chains. I mean, of course, there are sometimes restricted because of people suddenly, getting excited about nationalism, but that apart. Growing developer experience, comfort of lenders, favorable policy, vigor initiative. But I would focus on the last thing. How can project structuring and risk mitigation help in making projects more viable? And that has been my work. And when Professor Anish said that I do earlier and think later. So perhaps what we do is we set up projects which are de-risked. And I think it follows from a very simple principle of empathy. The thought that if I was an investor, what would I not want to do? What would make me feel comfortable, uncomfortable? So you want to do things which make our investors feel comfortable. And yes, we analyze things later, but the thought behind it is that. So develop projects where large number of risks are mitigated, essentially so that the developers feel comfortable. So I would run through some projects fast. I would not spend too much time about it because it's not a renewable energy or an energy or an engineering sort of a session. But I think I would finally focus at the end on the essence of it all. But I would take you through some projects to just give you an idea. So just to give you a background, how renewable energy projects have been set up in the country are that there has been some big government of India organizations, SECI or NTPC. They do everything, have been doing everything to set up a project. And there is some sort of a joint venture of them and a state organization whose job was very limited to arrange land and develop infrastructure. That is how our company was created. REWA was our first project, REWA Ultra Mega Solar Limited. But I mean, that was our initial mandate, but then I was looking up, I got slightly noisy, so we started doing everything. So now, this is the only organization in the country where the joint venture is not limited to just doing this part, but does everything, arranges the land and infrastructure, yes, but does everything, conceptualizes projects, develops the documents, conducts the bidding, etc. So we are the only organization in the country that does the entire thing, though we are at the state level. So this story that Professor Anish talked about was a REWA project. At that time, that was the scenario in India. 4.5 rupees, it was thought that solar is by nature expensive. At that time, the prevailing tariff in India for thermal was 4.5 rupees per unit. And it was thought that to encourage DISCOMs to buy solar, it should be made at 4.5 rupees. So Government of India made a benchmark of 4.5 rupees and said that solar obviously cannot be given at that rate. So there was a bidding on a viability gap funding. And the company seeking the least viability gap funding was awarded the project. So these are the sort of, so SECI had a 7 paisa trading margin. This was the target tariff. They would add 7 paisa, sell it at 4.5 rupees to the states. And the VGF was fairly substantial, around 10-15% of the capital cost. NTPC also used to do something similar. In that scenario, we at a state level set up a project without any subsidy. When Government of India companies were giving subsidy to get solar at 4.5 rupees, we got a first year tariff of below 3 rupees and a levelized tariff of 3.3. Without any subsidy, it was a new company set up in 2015. This was 2017, February. We didn't have we still don't have permanent office. We had just part-time staff, 7-8 people. The principles that we used were de-risking, which I would come to later. This is what we achieved. Large number of companies participated, around 20 companies, and some of them were International SoftBank from Japan, NG from France, Enel from Italy, Sembcorp from Singapore, a Mauritius company, a Canadian company, large number of Indian players as well. After that, the Government of India, the interesting thing was I rung up, our bidding went on for 36 hours. It started in the morning at around 9 a.m. It went on all through the night, the next day, and finished 7 in the evening. I rang up the secretary, MNRE at that time, Mr. Rajiv Kapoor, and he said, Manu, you have made life very difficult for all of us. Because Government of India had to explain a lot why they were giving money, and there was no corruption or anything like that. That was not the angle. It was just about structuring. By they were giving money to get power at 4.5 rupees, well-established companies, and how a new state-level company could get power at below 3 rupees. So then, all tenders of SECI and NTPC were withdrawn, and you see Mr. Venkaiah Naidu here because we also I'll come to that, to Delhi Metro that Professor Anish mentioned. He was the Urban Development Minister at that time. Anyway, then Government of India issued something called Standard Bidding Guidelines, largely based on what we have done. And now all projects in India run on those guidelines. We supply part of Delhi Metro as well from the project. The project was inaugurated by the Prime Minister. World Bank does a lot. This project is highlighted a project which has ring-fenced the wider uncertainties of an emerging economy from that project. So it is highlighted as that project which showcase, World Bank showcases it a lot, that how you can effectively de-risk a single project from the wider uncertainties in the emerging economy. So there is a case study in Singapore Management University, Harvard uses it, Capacity Building Commission of India recognizes the project. Now shift to a small project. This is a big project. REWA is 750 megawatt. 750 megawatt is spread over, just to give you an idea, 1500 hectare. Since most of you might not know what a hectare is, you can say an area project is spread over 15 square kilometers of land. A project over 5 kilometers and multiplied by 3 kilometers, it looks like a sea when you pass by. And now I would compare to rooftop solar projects. I would do it purposefully because the sheer difference in the scale. But the point is that the principles are the same. So here again, this is the prevailing DISCOM tariff. These are the tariffs we got. Lowermost tariffs in the country. Large participation from bidders. I always have good project, a lot of bidders would participate. The projects are successfully commissioned. A large number of buildings, including Government of India buildings. I would give you an example of IIM Indore. I hope it's allowed here. So this project...
Our students are now faculty at IIM Indore.
So this is zero investment. So that is the principle that I always say. Our projects are zero investment. Savings from day one. The project is commissioned 21. IIM Indore saves around 4 lakh rupees per month. So I say zero investment, savings from day one moving towards net zero. ADB has done a case study on the project. It talks a lot about the project. Again, this is recognized by the Government of India. Just an example, say medical colleges. In Madhya Pradesh, 7 medical colleges, the project has been set up, zero investment by the state. They save 20 lakh rupees per month. No investment from their side. Niti Aayog is working on replicating the same project in other places. So we have been using the same principles to set up other projects as well, about which I would not talk in that much detail. So the next project was double the size of REWA, 1500 megawatt. Again, we got very low rate, much lower rate. What we have done is most power projects have supplied to DISCOMs, so utilities. We have gone beyond that. Our first project supplies to Delhi Metro. The second project supplies to Indian Railways in 9 states. Then we set up a floating solar project. It's a fairly big project, 278 megawatt project, quite reasonable tariff. 278 megawatt is over, you can say 550 hectare. You can say it is almost over 5 square kilometer on water on a big dam. So big project. But so now solar is now much cheaper than thermal. So I'll just give you an idea, because that is, I think, something you should remember and try to take with you beyond de-risking everything. We did a tender in Madhya Pradesh of coal-based power plant, and we got power at 6 rupees per unit. And this would become more expensive every year as coal becomes costlier, transportation becomes costlier. And we did a tender of solar, and we had a flat inflation-proof tariff for the next 25 years. And we got a tariff of 2 rupees 15 paisa. So that is the difference. So today, solar is not just cheaper, it is much cheaper than half. It's around 1/3 the price of thermal. So what I have mentioned here, that the question of solar has been solved. Now the only question is what happens beyond solar hours. Because then you can say that, fine, but I mean, what happens when I'm watching a movie in the night or going to the mall, what happens? So our next project actually answers that question, that what do you do when you go to the mall in the night or do whatever. So what happens after the sun sets? So we had this project which has been bid out very recently, 19th of September, 3 months back. So this project supplies power during solar hour, yes, but 2 hours in evening peak and 2 hours in morning peak. And we have got a rate of 2 rupees 70 paisa per unit. So this translates because of, I mean, I don't know if it's done for us, but since dollar is 90 rupees now, so it's just 3 US cents per unit. So it translates wonderfully. So US and West lapped up very well. And this bidding was on 19th of September. And World Bank had their annual meetings from 12th of October. So they invited me to present that over there. So it has been a sensational thing, because especially the pricing of US 3 cents per unit for 4 hours of storage. I'll just briefly explain the project about how things can be de-risked. So what happens that it's like an interesting mix. The sun rises, a part of energy is supplied real time to utilities, and a part of energy goes to charge the battery. And then in the evening, when the sun sets, then this charged battery is discharged, and that is how you get 2 hours of evening peak. And then we have done something very interesting. In the night, late night, after 12 or so, when most of us and some of you, perhaps at 1 or 2, when they sleep, then the power consumption really reduces. So around 12 in the night to 5 in the morning, power is very cheap. So then what we do in the late night hours, we charge the battery again through cheap power, and using that we supply morning power. So this is the sort of some de-risking that we did. So then we compared it with, so I said it's a sensational tariff. So we thought we would compare it with some other projects. Now, interestingly, no other project was comparable. So we did a lot of calculation, and broadly speaking, we could locate that if we found 2 projects in India with the cheapest project tenders that we had, the reigning rates, we picked them up and we compared them. And we found that if we compare our project to a mixture of the cheapest tenders in the India till then, even then there is substantial saving even from the existing cheaper tenders, because of the interesting project structuring that we have done. We are working with University of California, Berkeley. California, Berkeley has actually set up a center in Bhopal to work not only on technical issues, but also policy issues, etc. And I would request Professor Anish from his center, or any one of you, if you want to collaborate or do anything, we're more than happy to do that. I would also tell you what we are planning next. We are planning to increase the period of storage. We are planning to set up projects big enough so that the excess solar could be used to charge the battery. So you want to increase the period of storage. But finally, what we aim is this, that the solar should be big enough to charge the battery so that we get the same level of power for all 24 hours. And that is what has excited California, Berkeley a lot. Their reading reveals, their analysis reveals that we should, if in this last project of ours, we should get a tariff of rupees 5 per unit. And as I said, coal today is costing 6 per unit. Now, if we can establish that we can get power from this project at 5 cheaper than coal, then we have philosophically established the point that renewables can be a reliable way to handle our energy requirement. As I said in the beginning, that we are at a happy moment when both economic viability and environmental considerations point in the same direction. Now, this would be a most beautiful proof of that. So, we are very excited about this project. Now, I would come to, these are all examples that we were talking about. So, now I would come to the main part of what I would like to talk about. That why do we say, Gireesh would say the same, and not just because you're the same college and the same department. I must tell you that like many other places, hostels don't go along well together. So I don't even know Nilgiri, where I was, in Aravali, that he was, what sort of relations we had, but anyway. So I would talk about why do we say that project structuring is important? Why do we say that can play a big role to, so why is it important? So the first point is that you get far more developers. I gave you an initial example of Riva project. We had 20 bidders. The bidding went on for 36 hours. Now that by itself brings down no developer wants to provide power at a cheaper cost. They would only do it when there is a transparent bidding and there are a large number of bidders. In the last bidding that we had of Morena that happened on 19th of September, we had 16 bidders. The bidding, because we had to reduce the time, etc., didn't go on for that long, but it started 11 in the morning, finished a few minutes before 11 in the night, went on for almost 12 hours. So if you have a de-risked project, you have more developers coming in, especially developers who are from outside the country, from OECD countries, because developers who are from India, they have understood how to game the system. For example, buying land in India is a very fishy exercise. So they are now adept at buying land in Indian market scenario, etc. But a foreign developer would not want to buy land. So what we do is develop a park. We develop buy the land, arrange the land, get government land, etc. And then we provide it on a platter to the developers, like a plug and play structure. So essentially we have large number of developers and that is why our projects are being showcased. When I said that World Bank talks a lot about our projects, it says that how we have ring-fenced the uncertainties of the emerging economy. For example, buying land. How we have ring-fenced that, because we said that buying land is not your bother, we would do it. Things like that. The important part is that you get cheaper equity, because there are large number of investors, pension funds, sovereign funds, etc., which are interested in investment where their returns are assured. They don't mind low returns, but they are keen on projects where the returns are assured. So if you have a de-risked projects, you get all those developers interested who are willing to come up with projects with a much lower ROI, who don't want setting a project to be like a visit to a casino. So that's why you have a different set of investors who go in for, let's say, an oil and gas exploration. But because in oil and gas exploration, if you get oil and gas, you're very rich, but in a lot of times you don't get oil and gas. Now they don't want that. Now in a solar project, the risk, it's a very de-risked project. Once you have commissioned the project, as long as there is sunlight and you have a stable power purchase agreement which makes sure that you pay on time, you would continue to generate energy and sell power and get money. And if you have provided the land, if you provided the evacuation infrastructure, if you have provided the stable power purchase agreement, then the risk of commissioning has also been substantially reduced. So that is why such developers who are interested in assured returns are interested in your projects, and you get cheaper equity. More important, as Gireesh also mentioned, that as far as a lender is concerned, for a lender, there is no upside of a project. Even for an oil and gas exploration project, if you strike oil, the lender doesn't get money at a higher rate of interest. They get their just money. So they are interested that they are far more keen on a de-risked project than even the equity investor, because they never get the upside of the project. So you can afford to get far cheaper debt if the project is de-risked. And finally, what is the cost of the project? Essentially, it is equity and debt. So if there is a project that gets you cheaper equity and cheaper debt, that's a cheaper project. And it's a cheaper project, you get cheaper energy. And that was the first, that's how I began my speaking at Professor Anish's advice, that you must, so it's important that renewable energy becomes cheaper. Unless it becomes cheaper, people will not be using it. To convince people to use it because ice in Antarctica is melting, I don't think it's going to happen. It would happen only when it becomes cheaper, and we are making it cheaper by this de-risking. Then there is a reduced chance of project failure, because government also makes some investment. Governments, all our projects, really, there is not too much of investment from the government, but government's decisions regarding procurement of power are based on a certain project. Now, if that project doesn't come up, then the planning gets disrupted. And then there is some public infrastructure, transmission infrastructure, etc., that one develops. So that is taken care of. So these are the benefits. Now, how we do that, I think it is, I don't think we would have time for that. And that is something that I would like to welcome you. Each one of our project would be a good research project to work on. I would say that it would be beautiful research problem. A de-risking of each of our projects could be a wonderful research problem. We would help you with how we have done it. As Anish said, we do later and things. So you can analyze what has been done. Perhaps you can analyze more fundamentally what are the benefits, how we can improve things, etc. But I would broadly, in a very limited, just one slide on it, that what do we mean by when we say project mitigation? One is the transaction structure. What do I mean by transaction structure? Firstly, I would like to say that any concept which needs an Excel sheet to convince the other person is a flawed concept. If you can't convince someone over a phone call, on a call, sitting as Gireesh is, in a bar, holding a drink, then there's something wrong with the concept. So the transaction structure is something very, very simple. For example, in our Murana project, one of the things is that it's a dual cycle project. The essential thought is that the most expensive part in the solar and battery structure is the battery. We are using the battery twice because the sun notoriously rises only once in a day. So how do we get the energy for the charging? So we use sun for the first charging, but in usual projects in the country, the battery is not used after that. So there is solar, charges the battery and discharge the battery, and then you wait for the sun to rise again. In our project, what we have done is that battery being the most expensive part, we use it again. So we charge battery using the nighttime cheap power, and you reuse the battery. So that is something about transaction structure. So for example, plug and play, that instead of letting the developer buy the land, develop the evacuation infrastructure, we provide, it's a plug and play structure. So that is again a transaction structure. So broadly speaking, things that make the project more efficient. Then you have to develop the project well. For example, in all our projects, when we say that we would provide the land is actually available when the bidding takes place. It is not that we start providing, arranging the land after the bidding is done. The day the bidding is done, we actually have land in our possession. Then we have a lot of contractual provisions. We do a lot of work on developing the contractual provisions. For example, in India, typically, let's talk of a road construction project. Very often, under the contract, you would have 3 years to construct the road. Government has a responsibility of giving land for construction of the road, and government will give the land after 2.5 years. And so now we have what the contractual provision we have is that day zero is not when you sign the contract. Day zero is when we give you 90% of the land. So there are a lot of such things, but and this is actually, what you can work on. That what was good in our transaction structure, because I don't think there's the time for this in this session. What are the contractual provisions, etc. And then the most important part is parking of risk. The risk should be parked with the party that is best placed to handle it. Now, I would illustrate this with a very interesting example. When our first project came up, Riva is, not many of you should know where it is. Why should you? So, Riva is a place close to Allahabad. It's in Madhya Pradesh, but it's adjacent to Allahabad, let's say. So, now, we are supplying 1/4 of the power to Delhi Metro. Now, how it is done is that there is a grid, you inject power here, and Delhi Metro draws power at Delhi. That's how it is done. Now, when the project was bid out, at that time, there was a policy of Government of India which said that transmission of renewable energy is free, no losses, no charges. So, Delhi Metro wanted the delivery point to be at Delhi. We were more comfortable with the delivery point being at Riva. It seemed to make no particular difference because since the transmission of renewable energy was free, then it seemed to make no difference whether the delivery point is Riva or Delhi. Delivery point, I'm sorry to that, but just to explain, is the point where the obligations of the buyer start and that of the seller finishes. So it seemed to make no difference, but we insisted upon the delivery point being Riva. And so the risk of transmission of energy from Riva to Delhi fell in the basket of Delhi Metro. Now, this decision really saved the project because what happened, this was the policy of the Government of India that would be free. But when the notification came, the notification said it would be free for discoms. Delhi Metro not being a discom, it was not to get the benefit of this free transmission. Now, the cost of power was less than 3 rupees and the cost of transmission was almost 1.5 rupees. Now, if this fell in the basket, if this risk had fallen in the basket of the developer, the project would not have happened and I would not have been called today to speak. Because developers would have found some way or the other to walk out of the project. But since the delivery point was kept at Riva, this fell in the basket of Delhi Metro. Now, Delhi Metro being a government organization was far better placed to convince the government that this regulatory position should be modified. So the stand that Delhi Metro took was that there is a certain court order which said that railways is almost like utilities. Let's not get to the legal argument. It said that it's almost like utilities. So whatever benefit utilities get, the railways should also get. So Delhi Metro said that they are like, railways is like utilities and we are like railways. So we should get the same advantage. So on that basis, Delhi Metro could convince the government that this advantage should be given to them as well. A private developer would never have been able to do that. So the point being that whatever is the risk has to be appropriately placed with the stakeholder who's best placed to address the risk. I think I'm almost approaching the end of what my time was. So I think I would come to the last slide. Professor Anish said that we act and think later. Yes, he's quite correct, but I would say there is some philosophy that guides what we are doing or some basic principles that guide us. So firstly, and I would mention it especially because I speak very often to people in the government, and this is required to be said. So government usually has a tendency to repeat what has been done earlier. So there has to be an urge to improve things, which is very often missing in the government. The other is again a problem that government suffers a lot. We don't listen carefully to what other people are saying. So we, especially policymakers and people at top of any organization, because that is a problem with all organizations have a hierarchy, and the person at the top of the organization should be listening carefully to what others are saying. that government is not just a contractual, is a contractual party, not just a sovereign. The other issue is that we must, in India especially, this is a problem. People seem to think that knowledge flows from position. So if you hold a certain position, then you know everything. I mean, ideally, in an ideal world, I would say that position should be determined by knowledge. It's an imperfect world, so that does not happen, but at least we should listen to others. And the point is that with all this, us is a very small organization, as I said, not a permanent office, very few people, but consistently over the last, REWA was 2017, it's 2020, last 8-9 years, we have consistently got very good results. We have consistently got results that have got global attention. And we have been trying to prove that renewable energy can become cheaper. But I believe the lesson is beyond renewable energy. The lesson is really for all public-private partnership projects and really about all infrastructure projects, the de-risking that I talk about. And then the last point that I have been discussing with Gireesh as well, that very often we talk of climate finance. We talk of the West having some sort of a obligation to give concessional finance to developing countries, etc. And that it's an obligation to. So while that may happen, and I have no ethical objections to that at all, what I maintain is that if we structure our projects well, then flow of capital is not a challenge. And I've quoted this from Midsummer Night's Dream because usually it was said that, I mean, the man is supposed to, chase the woman or follow the woman. So, but in Midsummer Night's Dream, they say, Shakespeare has said that Apollo, the man flies, and Daphne, the woman, follows him. So this can happen if we structure our projects well. It's not a Midsummer Night's Dream. It can happen. It needs continuous innovation, but through de-risking, through proper structuring of the project, we can get better results. If anyone who wants access to the presentation, it is, and most happy to answer questions, which I suppose Anish is proposing. Thank you.
Thank you so much. Thank you so much, Manu. This is, I don't have to get up actually. I'm already mic'd up. So, no, please hold the mic. I am mic'd up. So, thank you so much. This is very nice sort of two sides of the coin. And he said, many of you may not know where is REWA. Recently, I don't know if you know about this Hindustani vocalist Pratibha Singh Baghel. She's from REWA, by the way. She's making waves on multiple YouTube channels and all that. And they have a nice intro to REWA before they introduce her. So
they talk about white tiger and things like that.
Yeah. So REWA got another celebrity apart from Mr. Manu Srivastava. So let me build up this conversation. I was planning to ask a question first to you, Gireesh, but since he's ended up on a set of takeaways, even quoting Shakespeare, how about I start with that as a so we do use the case, the HBS case and the SMU case on REWA in our classrooms, and usually we split students. Students in our case would mostly be people who are older than us, executives who are senior policy makers and others in the classroom, and some of them, and we'll encourage them to take a critical look at it. And the first critique of the model that comes up often is how scalable is this model, right? REWA mein aapne kiya, how scalable it is. And then we build up a counter argument on what part of it is scalable. And then, eventually somebody will raise this question, see, a lot of this happened because of Manu being there doing the innovation, right? And then they ask, how many Manus do we have in the country to replicate REWAs across the country? I would like to build on that question. Whenever they ask this, I said, next time we invite Manu over, we'll straight away pose this question. So let me start with that question. How scalable this is and how much this success is contingent on the entrepreneurship and perseverance of the person you mentioned from the government side leading the whole project?
I would agree that that is a challenge. I have personally been working a lot on sharing what I do, what I have done, and I have looked at all opportunities to reach out, talk about that. As I said that the bidding of REWA was in February of 2017. And then we worked with Government of India to, I mentioned that as well, to develop the standard bidding guidelines on how projects could be structured, using those principles. So it has been legally notified. Now, when I was doing that, I was aware of the fact that if you set guidelines, that inhibits innovation again. I realized that, and I had raised this point then. But the view taken by the government was that at least it ensures a certain level of standardization, which I agree. So after that, the prices of renewable energy have come down. But I agree with you that there is a natural, I find it very strange, resistance to do anything interesting and innovative. I mean, I would agree with you in the sense that renewable energy prices have come down. But for example, we supply, apart from the utility, to Delhi Metro. Now, the only replication of that has happened is the next project that we did, wherein we supply to Indian Railways. Now, what confounds me is that there are refineries in the country, there are ports, there are airports. Why don't other organizations set up projects supplying to them? And I mean, as anyone interested in the renewable energy sector would know, there are 40 gigawatt of tenders lying in the country, 40,000 megawatt, whereas PPAs were signed by Government of India organizations and no state is willing to buy. So the 40 gigawatt of investment, what sort of investment would that be? 40,000 megawatt, imagine, 40,000, 200,000.
One gigawatt would be around 1 billion, so 40 billion plus.
So that is a sort of investment. It's an embarrassment internationally. And it has not, so this is something that I also find, I mean, I have a converse problem. I find it boring to do something, that has been done again. So, but I mean, I realize that that is one end of the extreme, that you find doing the same thing again boring. That is also a problem. But not to be trying anything new at all is something that I suppose government has a problem. I mean, this is sad, really speaking. I would agree with you. And this is actually something I've heard often, this comment. I do agree that I took a lot of risks. I mean, in the process, I took a lot of risks in how I did it. But once the project was successful, now we have tried to, Government of India has codified. So a lot of things have been made simpler. But really, I would say that government also does not incentivize this as well, yes. As a policy. I mean, so there are challenges, but I suppose this is the best one can do, and I can say that it gives one extreme sense of satisfaction. I mean, and also to anyone close to you, anyone who has been a part of it, it's a very immensely satisfying experience personally. But yes, I concede your point, and I take that. Yes.
Thank you. But this also is kind of a, if some of you are like intently.
But I would add that perhaps we can work together to sort of distill the learnings so that they become more. They can be understood better. And, same thing actually is possible in other countries. See, when I say renewable energy is cheaper than fossil-based energy, this is actually true in India. This is not true in large number of other countries. Yeah. And this is true in India in spite of a pushback from the coal companies. Because in India, what is happening is that coal is making life difficult for, the renewable is making life difficult for coal-based plants. Now, compare it to Africa. Africa, there is no power. Africa, sometimes at many places, they are running power through diesel, through fuel oil. So it is even more expensive than coal. So there is a lot to do. So actually, organizations like IIM Ahmedabad, like Oxford, we can work together to convey these stories outside. So I have personally tried to work with World Bank, with ISA, with all those organizations to talk about this, but I suppose it can be done in a far more structured manner.
And that's exactly the point. I think, the entrepreneur in you is like taking one step ahead of what I could anticipate. That is exactly what I was trying to suggest the researchers in audience, especially people who are researching, bureaucratic systems, organizational studies, organization systems, and intrapreneurship, not just in a corporate setting, but also in a public setting. I mean, these are extraordinarily rich case studies, which needs to be distilled out. Even in the practitioners, like, don't really get it. They feel there are like hidden aspects of the story that has not yet been uncovered for us to confidently say, now we can replicate. It seems like the mystery element still seems to be the bureaucrat at the top. And the bureaucrat at the top is saying, demystify me, can we sort of, make it into SOPs. So that is where I feel a lot of research potential is there, and you have somebody who is open to sort of discuss and share. We should definitely.
Especially the specific item could be the de-risking of these projects. That for how, Morena, for example, recent project, what are the specific de-risking initiatives that enabled the low price? And this would be true across geographies.
Right.
The risks might vary in some other countries. Some risks might vary, but that could be very interesting.
So, that's a nice segue to move to you. De-risking. You work on a completely different side, the physical risk part of it, but then it flows straight into the project risk, the portfolio risk, and as you said, not retrospectively, but into the future.
I would say that Gireesh's presentation was on physical risk. But Gireesh doesn't limit himself to physical risk.
That's right. That's right.
He addresses all risks.
Yeah, and this is there's a strange nature of this risk. The climate risk, like what they say, it's like it's slow moving but fast arriving. Very slow gradient, but then it's right around the corner, and we're already facing it. How do these kind of external shocks, which directly affects companies from a pure finance perspective, how does that translate to behavioral aspects, policy matters, or even research question? How do you make it like now? That NPV. How do you show the NPV now?
Yeah. Actually, before I answer, is this better?
Yeah, should be.
Can you hear me?
Yeah, it's better.
Before I answer your question, actually, I wanted to connect with what Manu was saying. When we look at even renewable energy projects, or when we look at other technologies, green steel, green cement, there's always this question around concessionality. And that's where the climate finance discussion also comes around, that the project should be given concessional finance because the green projects are more expensive in general, right? And what Manu is trying to show is that the concessionality part, or even what we call risk mitigation parts, comes at the end. What we need to have is projects that are well structured, right? Because a lot of the risks are in policy. A lot of the risks are in what we call designing the project pipeline. So if you talk to financiers, right, they usually don't talk about, we are looking for concessionality. They say, we are not finding a good project pipeline to invest in. And what you're doing is you're providing that project pipeline to invest in. Yeah. Now, coming back to the question you had asked. So why we did this research, and Manu is right that I do a lot of different things, and I kind of ended up focusing on one aspect. Actually, my background is in energy policy and finance, so I'm closer to Professor Garg's work. But this physical science work is becoming interesting. And the reason is that, as I was mentioning in my talk also, obviously, the whole conversation can be around risk versus opportunities, right? It's not just risks. If I'm looking at an energy transition within a country, there are risks to certain companies, let's say coal power companies, gas power companies, right? But there's also opportunities for renewable companies, and we try to kind of identify both of those. But the bottom line is what we are trying to do through our research is going from what's happening in the scientific domain, we have these cyclones or floods, etc., or we have this financial or energy system kind of transitioning. What we want to get to is what is the likely impact on financial metrics, right? Because at the end of the day, the money is going to be spent by the financiers and the developers, and they need to know what is the likely impact on the decisions they have made before, or the decisions they're going to make now, or the decisions they're going to make going forward. And that's what we're trying to be. I mean, I'm not saying that the research we have done and the numbers that I have given are the final numbers, right? But what we're trying to do is kind of create awareness, create transparency that these things exist. For example, this flood-related physical risk should be measured when you're making investment decisions. Because if your returns are going to be 25% lower, you should take that into account and potentially manage against those risks by investing in adaptation options in your kind of capital expenditure. So that was the whole idea behind doing this research. One other thing I would add is that a lot of these risks, I talked about transition risk, I talked about physical risk, are not accounted by the financial community. Or at least they're not transparent around these risks, even if they know. So you think about systemic events. Think about systemic catastrophes, like the housing crisis that happened in 2008. You could argue that the banks didn't know about the mortgage crisis or the mortgage issues, right? Some banks perhaps did not, but many banks did. But they were not making those transparent. So one of the things that we've been kind of arguing for, including with RBI and SEBI, is that we need to have disclosure. So people who are actually investing, I mean, even asset managers or even banks, they're investing on our behalf, right? We are the ultimate investors. So we don't know how risky our investments have been. So if we can create this body of knowledge that kind of makes this whole thing transparent, and then the regulators kind of mandate that these should be disclosed. And not only the risk should be disclosed, but the companies and the financiers need to talk about how they're managing those risks. This is classical financial management. But this information has to be out there, just like, reporting on financial statements, right? So this is what we are trying to do.
Fantastic. Also, I'll share, recently we're talking to some hedge fund managers from Citadel and, Jane Street and all, and, we put on our business school hat and we ask you, do you hire from our grads? Would you be interested? And, what is happening in the placement scene? And they said, we are hiring some atmospheric scientists and climate modelers. Why would a hedge fund sitting in New York working with, maybe close to $1 trillion asset under management be hiring atmospheric modelers? Because they see this as material, long-term, a source of alpha. If you can design your portfolio which is resilient to a potential future catastrophe, you might have a better alpha. Which brings to this thing that a lot of the research here is potentially interdisciplinary. You can't do that without having science in place. You cannot also do that without knowing finance and management in place. And that's where this platform also we kept deliberately interdisciplinary. Many of you come from science-ish background, energy background. Many of you are coming from pure org science and public policy background. A lot of opportunity to collaborate.
So another huge risk that is there, which is again an impact of what all is happening. A lot of investment in thermal plants today is not happening because people see that if you set up a plant, take a decision of setting up a plant today. The plant would come up after 5-6 years. The plant should have life of 25 years, which means we are talking of 30 years from now. Now, I don't think anyone would imagine that even 30 years from now, a thermal plant can continue to run. Because by that time, renewable would be cheaper than even the cost of the coal that you put in. Because even today, when I talk of a 6 rupees thermal power, the fixed cost, meaning the cost of machinery, land, etc., is around 3.5 rupees per unit. And the variable cost, that is the cost of coal that you put into that, is 2.5 rupees. So even if there is a running thermal plant, the cost of running the plant, the variable cost is 2.5 rupees, and solar today is cheaper than that. So all thermal plants today actually come down during when the sun is there and reduce their performance to something called technical minimum. Now, it's unimaginable that a thermal plant would be running 30 years from now. So definitely a thermal plant being set up today has to recover its cost in a much shorter span, while thermal is still being used. So which increases the cost of both equity and debt, since you are recovering it or not over 25 years, but over a shorter time span. And which makes thermal all the more unviable, because since you are doing it over a shorter time, you're making it more expensive, so which makes it even more unviable today. So I often say that we didn't move from stone age to iron age because we ran out of stones. So similar thing is going to happen with thermal plants. We're not going to run out of coal. We're not going to run out of thermal plants, but it is going to be just so pager thing to be using thermal plants.
We keep talking about Lalten to incandescent to CFL to LED. Now that LED has achieved cost parity, would you invest in a Lalten plant?
So there's an old movie, the Dilip Kumar and some Naya Daur or something. So the story is that Dilip Kumar runs a tanga, and the villain comes with a car, and there is a race between a car and the tanga. So in the film, the tanga wins. That can only be a film. A better technology can never lose out.
Yes.
And renewable is the better technology.
Yeah, just to connect to what Anish has asked and kind of is alluding to, actually, I want to also kind of talk about that a little bit. I talked about the Oxford Sustainable Finance Group, right? And I said we work on sustainable finance. We were at some point, we varied the number, sometimes been 20, sometimes 40. Imagine how many actual finance people are in the group, maybe 5, right? Because what we need is people from different departments. We have atmospheric scientists. We have like energy modelers, right? We have even behavioral scientists, because you need all of these disciplines. And that's why kind of in the beginning when I said that it's kind of a success story for us also in some ways like Reva, that we're able to put together a group and / department. We also are part of the Smith School of Enterprise and Environment, which kind of encourages that, right? And that's what we need more and more, because these problems we are starting to face, especially around climate, they cannot be handled by a single discipline alone. So that's the thing I want to add, yeah.
Thank you. I'm constantly keeping watch on the clock, watch on the watch. So maybe we can take a couple of questions from the audience. Punyashlok. Punyashlok, that would be fair here. I mean, you're our student. I think we should, honor the guest. I'll hold that question, anyone who is a visitor, and yes, sir. Sorry. Yes, madam, yes. Next is you. Yeah.
Good afternoon, sir. My question is for Manu, sir. You discuss for night hours. Do you consider winter session for North India? What happened in winter session?
Seasonality, fog, and etc.
Okay. Thankfully in Madhya Pradesh, except the extremely northern part of Madhya Pradesh, fog is not that much of a problem, thankfully in Madhya Pradesh. So it has not impacted. But yes, you're right that climate change also impacts projects which are working in that area, because pollution is really reducing the solar incidence and the performance of solar projects. So, I mean, it's like, cycle which everything impacts. So, renewable energy projects are supposed to be saving the environment, but they are themselves being impacted by bad environment. So, there is no end to these impacts on each other.
Okay, thank you, sir. One question for sir. We are dealing in informal finance, and we are doing research for farmers, small and marginal farmers. And if we apply your model in agricultural farmers, assuming them as a business entity, what is your suggestions about it?
Yeah, I mean,
and one thing, sir, kindly make comment about informal finance as well.
Yeah. These are all great questions because they are specific to India and similar situations. So one of the things that must have been clear to you from my presentation, that we were able to isolate the power plant, and kind of work on a model of a power plant. In cases where there's a large enough farmer, perhaps you can do that, right? But in cases there are like small farms, how do you do that, right? So what we are doing is we are actually setting up a research project to look at just that problem. And perhaps the idea is not to look at individual farms, but look at some level of aggregation, right? Because you have to get to a level of aggregation where you can measure risk, right? So that's one thing, but happy to talk about that more because we're just trying to set it up. I talked about the RBI researcher working with us. He's working on exactly that same problem. And so the other thing I want to say is, and this is why we need cross-disciplinary approaches, because not one approach is going to work, right? Sometimes we'll have to do this forward-looking modeling. Sometimes we'll have to use empirical techniques, etc., right? So using the right technique for the right kind of question is going to be important. The other question about is informal finance, right? And basically this is kind of what you're alluding to is SMEs, small kind of stakeholders, small finance, etc. And again, I think the issues don't go away. The risk is the same, right? Risk is not going to go away. It's just a question of how you're going to measure it and how you're going to make it material for the stakeholders on both sides of the things. So, yeah.
Well, thank you.
Second question from there, and can you pass the mic to her?
Hi, I'm Saurav on the left side. Yeah, I'm Saurav. I'm a PhD candidate at IIM Ahmedabad. I had one question from Professor Gireesh. You mentioned about the cash flows, and for the interest of time, you skip that part. In your paper, of course, I have not read the full paper. Do you consider the inflation as well as the technological changes in your cash flow when forecasting the cash flows?
Right. So we don't consider technology change because we are looking at specific power plants on the ground. But when you're doing modeling, like for example, the modeling that Professor Garg's group does, right? They are looking at how the prices of a certain technology is changing over time. So that's easier to do. It's just that in our model, we don't do that. In terms of inflation also, you could start with again, this is going back to the basic research concept, right? You have to start with a baseline model. So what we do is we have a baseline model. We have a power plant with a certain discount rate. And there are a lot of interesting questions within that. How do you determine the discount rate, which connects to inflation? So I would suggest is you start with the basic model and then you kind of do some robustness checks around that based on a lot of these assumptions. But the paper has a lot of this stuff because what I presented today is the base model, but in the appendices, etc. So we have a lot of these robustness checks that happen. Yeah.
Thank you. My another question is from Manu sir. Is that you talked about the renewable energy plants, solar plants, and all, and the practical approach. My question is on the end when the solar plant, the life of the solar plants is done. What about the waste generated? Because the waste is very toxic because it contains lead and cadmium. Is the government thinking anything on that side?
End of life story for solar.
Yes, the regulations are being developed, but I mean, I would, broadly speaking, I would say technology is being, riding a tiger. So we have to address the problems as they come, and I'm sure technology would have answers to that.
I can just add to that. There is some research which looks at the quantum of that problem, and it's not that big. I mean, it is a problem, serious problem, but if you compare that with, let's say, dismantling a coal plant or something like that, the total material in tonnage turns out to be far lower, but it's still a problem that needs to be addressed.
And just to add to that, you know what the best solution to the climate problem is? Do you know? Like, if you had to say, what is the number one solution? It's not on the supply side. Actually, it's on the demand side of things.
I keep saying, if you all stop breathing, I think that
exactly.
will stop the climate.
Exactly. We exist, right? But the thing is, this whole demand side, okay, we are existing for some reason, but the demand side, right, if you could reduce our consumption, right, which is where energy efficiency is, where all this stuff comes in. Yes. And classically, from an economist perspective, that's a very, very hard problem to crack. It's still not being cracked.
Thank you.
Yeah.
I think this question is for Shri Manu. one of the things that even this case we teach at IIM Indore in a particular course, in the river and then post that, we've seen that the government has taken a lot of new steps, innovative steps, right? We did go for viability gap funding, we did a lot of de-risking for the private players. My question to you would be that in this particular sector, if all the innovation is being done by the government, does it reduce the likelihood of the companies innovating in their, in this sphere? So it becomes like a public sector company which then awaits all the government help, and then they simply have to develop that and sell it. So there is no need to take any risks to develop new products. The entire value chain depends upon government.
No. I mean, we have only focused on project structuring, but a lot of other areas where developers, for example, choice of technology, because which panels to use, they have full freedom. Is it bifocal? So a lot of choices regarding technology. Furthermore, what we are doing is only about purchase of power by utilities. There are a lot of commercial industrial customers, projects are being set up for them as well. So there are a lot of choices regarding choice of battery, choice of panels, etc. So innovation is happening at multiple paces, and it needs to, they all need to work together.
And going back to what Manu, you had actually said before, I mean, there are different risks, right? And the risk should be distributed so that the land in the bucket that is best able to manage it, right? So it's connecting to what you said. It's not just technology, even financial engineering. There's a lot of risks are being taken by developers, right? So it's just how do you distribute risks in a PPP? That's what becomes.
And another very interesting development has taken place in the last few years, that in the renewable energy sector, two different companies have come up. One is called DevCo and the called Holdco. So Holdcos actually take over a company once the project has been commissioned. So then there is hardly any risk, because the project has been commissioned, there is sunlight coming from above, and if you secure PPA, then you're just generating power and getting money. So holdcos are particularly more risk averse, and devcos are the ones that are developing the project. So there is greater risk at that time. So the more entrepreneurial people, they win the bid, set up the project, and when it gets stable, then they sell it off to holdcos at a premium. So a lot of things are happening.
Just, I think, a follow-up. I mean, what would you say regarding financing such projects? As in a PPP, where does the liability for the failure of the project would lie only from the terms of, let's say, financing? Let's say if the government provides you with a lot of land, de-risking, and they get in World Bank, IFC, lenders, everyone through those connections, then what does the private player kind of bring to the table?
The private capital, they are bringing everything. They are bringing the equity, they are bringing the debt. The debt is being arranged by them. They are choosing the technology. They are designing the project, how they are setting the panels. They are executing the project. They are managing the project for the next 25 years. So everything is being done by them. So we are really only the pandit arranging the wedding, and then everything is done later.
They're making sure that the mandap is in proper shape. So, yes, madam.
Good afternoon, sir. Thank you for the insightful session. I have one generic question, sir. Since we have lot of solvable problems in emerging economies, and India is one of them, but most of the impactful work for these problems is being done from researchers abroad. Although we are also doing, but I feel it's not that impactful. Research papers are coming out. So what is it that we can do to solve our own problems and publish in good journals? Any tips you want to suggest, sir? Actually, I'm a research scholar from Hyderabad, IIT Hyderabad. So.
Yeah, I mean, what we are trying to do is basically create these collaborations, right? So that's one way to kind of increase domestic capacity. So in some sense, even when we are raising grants, it's becoming like, in a way, it's a requirement of the funders that we work together with local universities, local stakeholders. So that's one way to kind of increase capacity, but there could be other ways. Yeah. But I mean, we welcome any kind of collaboration. So.
So we can help you with research problems and what has been done, but how to write up articles and get published is something Gireesh should know better.
Thank you so much. We have last 3 questions. A young gentleman over there, yourself, and at the end we have Pragati. All right, one, and the last question over you. Yes.
So my name is Jia. I'm a second year undergraduate from IIM Ranchi. So my question was to Gireesh sir in specific, as someone who's really interested in optimization modeling approaches, specifically stochastic and robust optimization. So how do you go about assessing the protection measures and how are they reducing the risk? Because in order to assess the risk, you can use empirical data, right, of say flood-prone areas. But when it comes to those protection measures, how do you assess the impact of those protection measures, as you mentioned?
Yeah, and we didn't get into that much, but that's a really good question. Actually, what I highlighted was risk. I also highlighted what happens if you have adaptation options. What I did not highlight was, and this is something we are looking at, is the cost-benefit analysis. Because every adaptation measure is also going to cost something. And that has to become part of the framework. And that has to become part of not only the framework for an asset-level data investment, or for like protection or adaptation, but that happens at a portfolio level. And now when you're looking at portfolio level problems, they're all optimization problems, right? So you're kind of trying to connect to the questions that you're interested. Yeah, but we are happy to kind of talk more about this later.
Thanks, Dennis.
Over to you.
Good afternoon, and thank you very much for the session. My question is more from the demand side, the point that you raised right now. So while I learned a lot today sitting here, sometimes I think that the knowledge gets really locked up in a few places and doesn't trickle down to the common man who is actually driving consumer patterns. So as a common man, you don't know which car to buy, what is going to be more emitting. You don't know where the consumption pattern is going to go of the current generation, which is now probably in the age bracket of 0 to 20. So how do we sensitize people more towards these subjects? I mean, this struck me most when my son's school asked them to draw a Save Trees poster on a piece of paper. So there's a lot of disconnect that's there. So how best can we help the common man understand everything that's at play?
See, one way it is happening is through price signals. So, for example, what is being done in India now, as I mentioned, solar energy is becoming cheaper. So, to encourage more consumption of energy during solar hours, so now there is a discount of 20% on consumption of electricity from 9 a.m. to 5 p.m. So if you can perhaps cool your house in those hours and not later, or run the washing machine, etc. Similarly, there is a premium or penalty, whatever, it becomes more expensive in the morning peak and the evening peak, because at that time the demand really surges. So from I think 5 p.m. to 10 p.m. and 6 a.m. to 9 a.m. the energy is 20% higher. So actually there is a 40% difference in the price from the solar period 6 a.m. to to 5 p.m. and the next hours, and there's 40% difference. So that is intended to do the same. In many places, even in India, something more intelligent than that is being tried. Because this is like for a year, this 20% thing. But the price in the exchange market keeps on varying all the time. It's divided into 15-minute cycles. It keeps on happening all the time. So in Delhi and certain places, other places it has been developed, that some customers are allowed to be participate in a program. Therein the idea is that when the power becomes expensive, then you send them as information and say that if you reduce consumption during this period, you get this incentive. And many countries have a very elaborate program which says that because in India as of now, the consumer tariff is fixed for a year. So there what they do, but the real market is driven by this 15-minute cycle, whereas consumer rate is fixed for an entire year. So there they allow the customers to sort of participate in that. So customers can find out that power is more expensive, they can reduce their consumption, and the power is cheap, they can increase their consumption, and consumers can increasingly play a role in this. Now, because of battery, because large number of people have EVs, so the battery in the EV can not only run the electric vehicle, but it can also inject power into the grid. So what you can do is that you can charge your battery when the power is cheap. Let's say if it's cheap in the late night hours, you charge your battery. And in the morning, say 6 to 9, or evening, say you come back from office, let's say at 5 or 6. 6 to 10, the power is expensive. Then you inject energy from your the battery in your EV into the grid. So a lot of these things are being done. And at many places, what it's also doing is that it is bypassing the volition of the consumer. So what the consumer can do is connect if it's an IoT-driven thing, the equipments in the house to the market price. So the refrigerator would cool itself more, or the AC would cool more when the power is cheap. And it would cool less, or the AC would cool less when the power is more expensive. So it is connecting the appliances directly to the pricing. A lot of things can be done. And of course, there can be at a psychological level, behavioral scientists would have other things to suggest as well, but these are pricing signals which can do that.
This might be also a great point to end, but it's a great question actually, and this is a very philosophical question that you asked about the kids, etc. So, I'm trying to say some kind of technical terms, but they have relevance for individuals. People care about something when it's material to them. We talked about materiality, right? So, how do we communicate? And you're right that to a large extent, a lot of this is a communication problem because people don't understand, right? So we have to create the cases, right, where you're talking about smallholder farmers or households. What is material to them? You have to first create that information. Second, you have to be able to figure ways to communicate that information to those individuals or those stakeholders. And I think we are getting to that place through this multidisciplinary research, but also with AI and machine learning. Because if you look at your phone, right, the phone kind of understands you, who you are, what motivates you, what you're going to act on. So you could use the same technology, and by the way, this is a startup idea that I've been kind of toying with, right? How do you, find information that the consumer cares about, and B, communicate that to the consumer? Because it's not just about, I have a house that will have a flood risk and I'm going to lose $10,000. People also, and this gets into behavior theory, right? That it's not only what is material to me, what can I do about it? Because if people feel helpless, they won't do anything about it. So creating this whole solution that requires science, finance, behavioral science, I think that's a great field to be in, and especially for like the kids of today and also for entrepreneurship. So.
True.
Thank you for asking this question. Yeah.
Thank you so much. I'm mindful of the time. I'm really sorry I said, you both could take, but there is only our question standing in between their lunch. And I don't want you to, they might be wrapping up by now. So I think we should wrap up before that. Once again, thank you so much and to both our panelists.
And is anyone who wants to interact, we can perhaps do it over lunch or something? Or?
And yes, of course, thank you so much for offering that. Yes. We have two small tokens of appreciation for you. I see Professor Saravanan there. He's an executive committee member of the center. So Saravanan, please. Professor Garg is no longer is moved out. Otherwise, we could have invited him also. And participants, stay back. We'll take a group picture. For your memories, and also we have to share with our sponsors. So,
my details, if anyone wants details, this is my QR code. You can just take my details.
So.